towards renewable energy sources and efforts to reduce carbon emissions prompted governments to implement stricter regulations on fossil fuels. These policies, while essential for sustainable development, can lead to a decrease in oil production or increased costs for oil companies, thereby contributing to higher oil prices. Furthermore, unexpected events such as natural disasters, disruptions in oil infrastructure, or unforeseen market shocks can further influence oil rates in 2023. It is important to note that predicting specific oil price movements in the future is challenging due to the complex nature of the global oil market. Multiple factors, both known and unforeseen, can impact oil rates, resulting in fluctuations and volatility throughout the year. Additionally, global economic growth and increased industrial activities played a role in the increased demand for oil. As economies recovered from the impacts of the COVID-19 pandemic, there was a resurgence in energy consumption, particularly in developing countries. This heightened demand, coupled with limited supply growth, exerted upward pressure on oil prices. Moreover, supply-side factors influenced the oil market. OPEC, Organization of the Petroleum Exporting Countries, and its allies continued to manage production levels to support higher oil prices. Any decisions regarding production quotas or changes in supply policies by major oil-producing nations significantly impacted the international oil rates. In 2023, international oil rates experienced a significant increase due to various factors that influenced global supply and demand dynamics. These factors contributed to a surge in oil prices, impacting both consumers and industries worldwide. One key factor contributing to the rise in oil rates was geopolitical tensions and conflicts in major oil-producing regions. Any disruptions or instability in these areas, such as the Middle East or key oil-producing countries, can create concerns about oil supply and subsequently drive up prices.